Okay, in action. So what I want to do is to go over the memo review really quickly, and then go through the supply-demand logic. And this is really more for review for the sections 1 through 3, but also for section 4. I really didn't get to go over this with you. So I want to go over this lecture that I provided for the other 3 sections today on Friday. So let's go over it, and then if you could review these memos, these video lectures on the memos, that would be great, and I think it would help you out a lot. So first, in the memo on the formatting, under RE, you want to make sure that it says stock prices to rise, or stock prices forecast to rise 8 to 10% or 8%, whatever, in between that range over the next 3 months. You need to tell me what you're tracking. We are tracking stock prices, oil prices, gold prices, the value of the US dollar. We forecast stock prices to rise by at least 8 to 10% over the next 3 months based on the following factors. Make sure you don't put a capitalization there after the colon. You don't put capitalization after a colon. You only do it after a period. Therefore, we recommend the following, and it's got to be at least 36 trades. You want to bold the titles in the tables. You have to have at least 3 indices, 3 ETFs, and 5 stocks. If you are forecasting the price to rise, you are going to buy forwards, buy futures, buy calls on futures, and write puts on futures, in that order. You want to buy on margin, buy calls, and write puts for the ETFs, and you copy and paste that over into the stocks in the same order. You're going to buy on margin, buy calls, write puts. When you are forecasting the price or the value of the currency to go down, you are going to write forwards, write futures, write calls on futures, and buy puts on futures. Remember, the on futures should not wrap within the column, and there are no futures, no on futures for either the ETFs or the stocks. If the price is going to go down, you want to sell the ETFs short, so sell short, write calls, buy puts, and for the stocks, 5, you want to sell short, write calls, buy puts. So you just copy and paste it. For the tables, don't forget to bold and put in the subtotals and the grand total, or the total trades bolded to the right in the cell. Make sure that the column lists in the tables are the same, and make sure that there's no word wrap on the on futures in the first column. For the tickers, use the symbols and list the symbols for the indices, but you're going to have to do the research and look up the ETF ticker symbols and the stock ticker symbols, and they should not be the same. They're totally different. So you're going to have to do the research. The bullet points underneath the table, make sure that the bullet points are on the left-hand margin, and make sure that your last paragraph is not formatted to the margins of the bullet text, but go all the way out to the margin, okay? And then you want to bold in the bullets the key data points, the key takeaways. So I like to see bolded dollar values, change in dollar amounts, percentage change in dollar amounts, and bolding the key takeaways. Underneath the bullets, if there's a large white space, you might need to make another bullet, but make sure there's not a large white space in the bottom. You probably will have to put another data text in there with more data. So again, these bullet points should support your forecast and should support the supply-demand factors. And don't forget, at the end of the bullets, the bullet text, you need a period. Some of you did put periods in there. So that's the that section. Let's talk about the graphs, and let's talk about the last paragraph. Okay. So in regards to the graphs, oh, and in the tables, don't forget to have the trades and the tickers, the T's aligned, and the make sure that those are bulleted with the semicolons, okay? So for the graphs, they need to be proportional to each other. If you're going to have borders around them, make sure that the border lines aren't too thick, and make sure that the widths and the lengths of the graphs are the same, that they don't encroach over into the margin, that they're not too close to the table, not too close to the final paragraph. Make sure that there's a little white space in between the bullet texts and the graphs. So it's got to look, and it's got to be centered, you know, in that section of the paper. So again, proportional to each other. I got to be able to read the graphs, okay? So there needs to be a title that I can read. I should be able to read the X and the Y axes. They need to go back at least a year so that I can identify the trends and to be able to identify both the support lines and the resistance lines. And make sure they don't get too close to the table and the paragraph, if there's a space, and make sure the graphs don't encroach over into the margin on the right-hand side. And again, have the spaces between the graphs and the text. And then the very last paragraph in the memo is pretty straightforward. You want to copy the first paragraph once it's perfected and copy it and paste it as the last paragraph. You only need to make 2 changes. You are going to change where it says the following trades to the above trades, and then you are going to change the colon to a period. Boom, you're done with the very last paragraph. Make sure that the memo title is in capitalizations, that it's big enough, it's not too small, and it's bolded to be able to set off that when you hand it to somebody, they know it's a memo. That you make sure that also the text and everything, when you're looking at it on the page, that it's centered in the page, and there's a white space in the margins. Everything looks centered in the page, and make sure that there's not too much margin on any one side or the other, or too narrow of a margin on one side or the other at the top or the bottom, and that, you know, that there's a very small margin on one side and a large on the other. You need to fix all that stuff and make sure that all the formatting is perfect and you are handing me a business quality memo. Once you've done all of that, you've got the formatting perfected for the memo, you want to go back into the other memos and perfect and update those. At this point in time, when you hand in the memos, they all have to have a consistent quality formatting across all of the memos. If you're not getting consistent quality formatting across all of the memos, I'm not going to give you grades on stuff like that. It's got to be perfect because you want to be able to use these things as writing samples and meet the criteria for the class. Okay, that's basically the memo. Now we're going to move into the economics. Memo economics, take 2. So now we've went through the formatting, you know, for the memos. Now let's talk about the asset classes. There's 5 asset classes. It's going to be stocks, oil, gold, bonds, and currency. We're going to look at stock prices, oil prices, gold prices, and we are going at bond prices, and we're going to look at currency values. Okay. The first is going to be stock prices. Well, obviously, supply and demand for stock is going to have an effect on the price, and I'll get into the microeconomics in a minute. But what really drives stock prices that you need to articulate in your memos, in your factors, okay? And then to be able to articulate those within the bullets and show me in the graphs, and then be able to make the associated trades. So the first thing is what drives stock prices is dividends, earnings, revenue, net operating income, or free cash flow growth rates. So it's the growth rate per share. Also, discount rates. So discount rates, which are also have risk-free rates in there, which are really interest rates. And what you need to do is you need to memorize these equations and this logic right here. So I'm going to use the 3 stock valuation models, and I've integrated them together. So first, what drives the value of stock is going to be dividends divided by the discount rate. Dividends divided by the weighted average cost of capital, or the capital asset pricing model, expected returns or cost of equity using CAPM. And I'll talk about that in a minute. So D minus I, D divided by I. The second is D divided by I minus G. So if interest rates are going down, the discount rates go down. If discount rates and interest rates go down, then the value of the stock goes up. If the dividends growth rates are expected to go up, then the value of the stock goes up. If the dividends or the earnings per share goes up, the stock value goes up. If the price earning multiples go up, the stock value goes up. So review the logic, do the sensitivities on the variables to be able to just train yourself to know if dividends go up, the stock price goes up. If discount rates go up or interest rates go up, stock prices go down. If dividends go up, values go up. If interest rates or discount rates go up, values go down. If interest rates or discount rates go down, values go up. If growth rates go up, values go up. If growth rates go down, values go down. If dividends or earnings per share go up, values go up. If dividends or earnings per share go down, values go down. If the PE multiple goes up, the value goes up. If the PE multiple goes down, the value goes down. So you need to go through that over and over again so it becomes extremely easy for you to be able to forecast where you think the value of the stock market or stock prices are going to go based on information that you're reading. Lastly, the discount rate is either the weighted average cost of capital or the equity cost of capital or expected rate of return on the equity using the capital asset pricing model. The capital asset pricing model is the risk-free rate plus the beta times the return on the market minus the risk-free rate. The return on the market minus the risk-free rate is the market premium. The beta times the return on the market minus the risk-free rate is the market price of risk. So the market risk premium is the return on the market minus the risk-free rate. The market price of risk is the beta times the return on the market minus the risk-free rate. Now let's talk about oil prices. Let me get that set up.